Here's a question nobody asks out loud. What if the safest thing you're doing with your money is actually the biggest financial mistake you're making? You put money in your savings account. The bank keeps it safe. You earn a little interest. That's the deal, right? That's what responsible people do. But here's what nobody told you. While your money sits in that account feeling very safe and very still, the world around it is getting more expensive. And that gap is costing you money every single day. Most people treat their savings account like a finish line. Like once the money is in there, the job is done. Mission accomplished. Money is safe. But a savings account is not a wealth building tool. It never was. And if you're using it like one, if you're parking money there long term and expecting it to grow, you're not playing it safe. You're losing a slow, quiet, polite game. By the end of this video, you're going to understand exactly why savings accounts lose you money in real terms, how to calculate that loss yourself, and what smarter options actually exist without touching anything risky. Let's start with inflation because people throw this word around like everyone already understands it. Most don't. Not really. Inflation means that the same amount of money buys less stuff over time. That's it. That's the whole concept. Imagine you have a basket of groceries that cost $100 today. Milk, bread, vegetables, the basics. Now inflation runs at 3% this year. Next year, that exact same basket, same items, same quantities, costs $103. Your $100 didn't change. The basket changed. And that difference, that slow, invisible rise in prices, is inflation doing its job. Historically, inflation in developed economies runs between 2% and 4% per year in normal times. That's the target most central banks aim for. Not zero, not negative. Positive inflation every year, which means every year you're alive, the cost of living is going up. And if your money isn't growing at least as fast, you're falling behind, quietly, invisibly, mathematically. Now let's look at what a standard savings account actually pays you. In many countries, a standard savings account offers somewhere between 0.1% and 0.5% interest per year. Some are higher. Some, honestly, are lower. But let's use 0.5% as our number today. You have $10,000 in your savings account. After one full year at 0.5% interest, the bank gives you $50. $50. That's your reward for letting them hold your money for 12 months. Meanwhile, inflation at 3% means the purchasing power of that $10,000 dropped by $300. Pause. You earned $50. You lost $300 worth of purchasing power. Your net position, negative $250. In real terms, you lost money. The account balance went up. Your financial position went down. There's a simple formula that most people never learn in school. It's called the real return. And it changes how you look at every financial product for the rest of your life. Real return equals nominal rate minus inflation rate. Your savings account pays 0.5%. Inflation runs at 3%. Your real return is negative 2.5%, not zero, negative. You are guaranteed to lose 2.5% of your purchasing power every single year. Not because anything went wrong, but because that's just how the math works. This is what financial professionals mean when they talk about purchasing power erosion. The number in your account grows, the power behind that number shrinks. It looks like safety. It functions like a slow leak. And here's the part that really hits. This isn't a rare scenario. This isn't 2008 or some crisis economy. This is normal. This is what happens in a healthy economy with moderate inflation and standard savings account rates. The loss is built into the system. Now, before you pull your money out of your savings account, stop. Because this video is not telling you savings accounts are evil. They serve a purpose. The problem is when they're your only tool. A savings account is the right tool for your emergency fund. 3 to 6 months of expenses that need to be liquid, accessible, and stable. It's the right place for money you'll need in the next 1 to 2 years. Short-term savings, known future expenses. That money belongs there. But for money beyond that, money you won't touch for 2, 3, 5 years, there are better tools, not riskier necessarily, just better matched to the job. High-yield savings accounts, or HYSAs, are still savings accounts, FDIC insured in the US, government-backed in many countries, but they pay significantly higher interest. Depending on the rate environment, these can offer 4% to 5% in a high-rate period, or 1% to 2% even in low-rate environments. Same safety. Better return? Money market accounts work similarly. Offered by banks and credit unions, they typically pay more than standard savings accounts while remaining highly liquid. Not exciting, but meaningfully better. Short-term government bonds, treasury bills, I-bonds in the US, gilts in the UK, offer returns that are often at or above inflation with very low risk. They're not as instantly accessible as a savings account, but for money you won't need for a year or more, they do the job far more efficiently. None of these are investment advice. Every situation is different, but the point is, the alternative to a standard savings account doesn't have to be the stock market. There's a whole spectrum between 0.5% savings account and high-risk investment. Most people just don't know it exists. Let's clear up two mistakes people make here, because they're almost universal. If your balance is going up, it can feel like progress. But growth in nominal terms, meaning the raw number, means nothing without accounting for inflation. A 1% gain in a 4% inflation year is a 3% loss. The number went up, you went backwards. Always measure in real terms. Misconception 2. I don't earn enough to invest or use better accounts. Most high-yield savings accounts have no minimum balance requirement. Many money market accounts open with $1. The barrier isn't money, it's awareness. And that barrier just got removed. Here's what you can actually do this week. Not someday, this week. First, find out your current savings account interest rate. Log in, check the account details, find the APY. If you don't know this number, you're flying blind. Second, calculate your real return. Take your savings account rate, subtract current inflation in your country, and look at what's left. If it's negative, you now know exactly how much purchasing power you're losing per year per $1,000 saved. Third, look up what high-yield savings accounts are available in your country. In the U.S., institutions like Marcus, Ally, or SoFi regularly offer significantly higher rates than traditional banks. In the UK, look at cash ISAs and easy access savings accounts. Every country has options. They just take 5 minutes to find. And finally, separate your money by purpose. Emergency fund and an accessible account. Short-term goals and a better yielding account. Longer-term money, and that's a conversation for another video. You don't need to overhaul your entire financial life today. You just need to know what you have, understand what it's actually doing, and take one better step. Here's the one thing to take with you. Safe and profitable are not the same thing. A savings account protects your balance. It does not protect your purchasing power. Those are two different jobs, and confusing them is one of the most common and quietly expensive mistakes in personal finance. If this made you rethink where your money is sitting, the next step is understanding where else it could go, without taking on more risk than you're comfortable with. We'll cover that in the next video. Your money is always doing something. The question is whether you chose that or just let it happen by default.